Extra money coming in each month to help you save for the future or pay your bills sounds like a dream, right? What if we tell you that you can earn that while you sleep? Indeed, that's possible, thanks to dividend stocks. You can earn up to $1,800 a month in dividends, but if you're starting from scratch, it may take you some time to get there. So if you don't need the money right now, you can let the earnings compound towards $1,800 in monthly dividends while you also continue to buy additional shares. Hey, welcome to Stock Market Mate. Today, we'll talk about the top 7 dividend stocks that will pay you $1,800 per month. Make sure to subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Before we start, we need to talk about dividend yields. If you don't know what that is, a dividend yield is simply the return on investment in terms of the dividends you receive for the money you invested. The dividend yield is calculated by dividing the annual dividend paid per share by the current share price. For the money you invest, you receive a certain amount of dividends back. Now that we discussed the basics, let's get into our first stock. Number 7. JP Morgan Chase. JP Morgan Chase is the largest bank in the US, and over the past decade, it was the top performing large bank. Its stock also outperformed its peers during its pandemic recession, down just 5% in 2020 when the other large banks saw their stock prices drop by double-digit percentages for the year. JP Morgan Chase is a leader, or among the leaders in all of these various business lines. With its strong balance sheet, it is not only able to weather downturns, but it can invest in its technology infrastructure and data capabilities to improve efficiency and performance. In 2021, Diamond said the company plans to invest $12.5 billion in technology. Also, the strong balance sheet allows it to make acquisitions to further bolster its business. The company has indicated it is interested in an acquisition, particularly in the asset management business. Many consider JP Morgan Chase a good value because it is undervalued relative to its earnings power and position as a market leader. It has a forward price-to-earnings ratio of about 13.8, which is around the average PE for financial institutions. It has a price-to-book value of just under 2, which is not in value territory but is relatively low compared to its growth potential in an improving macroeconomic environment. The bottom line is, by any measure, JP Morgan Chase is a good buy right now. Number 6. Air Products and Chemicals Incorporated. Air Products and Chemicals Incorporated is an industrial gases company. The company provides essential industrial gases, related equipment, and applications to customers in various industries, including refining, chemical, metals, electronics, manufacturing, and food and beverage. The company is also a supplier of liquefied natural gas process technology and equipment. It also develops, engineers, builds, owns, and operates industrial gas projects, including gasification projects, carbon capture projects, and carbon-free hydrogen projects supporting global transportation and energy transition. The industrial gas giant shares have popped roughly 14% over the past 3 months. It is well placed for growth in its project investments, productivity actions, and new business deals. The financial health and growth prospects of APD demonstrates its potential to perform in line with the market. It currently has a growth score of B. Recent price changes and earnings estimate revisions indicate this would be a good stock for momentum investors. Number 5. PepsiCo. Customer staple stocks like PepsiCo can be a great addition to any long-term portfolio, as they're known to hold up well in recessions and provide consistent dividend increases over the years. While they may not be as exciting as some of the cutting-edge tech stocks that have been driving the market higher over the last few months, there's something to be said about a well-known brand name company that delivers steady gains and strong earnings on a steady basis. With over 49 consecutive years of dividend growth and a top-notch balance sheet, it's a very attractive option for investors interested in consumer staples. PepsiCo will be increasing its quarterly dividend per share to $1.075, payable on March 31, 2022, for shareholders as of March 4, 2022. That will be a 5% increase from the dividend in the same period a year ago and consistent with PepsiCo's announcement that it will increase its annual dividend to $4.30 from $4.09. Number 4. PPL Corp. PPL Corporation is a utility holding company. The company, through its subsidiaries, is primarily engaged in the generation, transmission, distribution, and sale of electricity and the distribution and sale of natural gas. Overall, there are several factors that make PPL Corporation a solid dividend stock option to add to your portfolio. This company has a good growth outlook over the next couple of years, and the company has a consistent history of dividend payouts and payout growth that is beating inflation. The inexpensive share price makes this an option worth considering now. The high yields and the positive predictions for the company means that PPL Corporation is a solid, if not exciting, dividend stock option for the long term. Most financial experts agree that an investment in this company is a sound option. PPL announced a quarterly common stock dividend of $0.20 per share, payable April 1, 2022, to share owners of record as of March 10, 2022. That's down from $0.415 per share last quarter. Number 3. Waste Management. As the largest waste and recycling services provider in North America, Waste Management has developed a reputation for being a best-in-breed income stock. Its business may not be glamorous, but its returns certainly have been. The stock is up 21% in 2021, which makes it outperform its industrial sector peers as well as the S&P 500. Let's dive into Waste Management's numbers and growth potential to determine if the stock is a buy despite its higher valuation. Waste Management estimates it captures around 20% of the annual $75 billion waste and recycling industry in the US long term. It sees potential in the burgeoning sustainability industry. Waste Management's industry-leading position, reputation for dividend raises, and relatively stable business model makes it a great dividend stock, especially for retirees. Given that so much of America's waste passes through the company's channels, it stands to reason that Waste Management is positioned to benefit nicely if it can prove it can profit from sustainability, but it will take imagination and time for this new growth outlet to evolve. Waste Management is committed to growing shareholder returns. It has a strong track record of dividend growth, consistently increasing the dividend rate for more than 15 years with a compound annual growth rate of about 6% over the last 5 years. Number 2. ExxonMobil Corporation. ExxonMobil Corporation is one of the world's largest integrated energy companies. If you're thinking about investing in the oil and natural gas industry, you should put this diversified global player on your shortlist. This company has shown a commitment to rewarding shareholders that no other oil major can match. To put a number on that, Exxon has increased its dividend year in and year out for 34 years. That's not the only reason to like the dividend. Right now, Exxon's yield is toward the high end of its historical range. This is a rough gauge of valuation, suggesting that Exxon is trading cheaply relative to its own history. Put another way, now could be a good time to buy the stock. Exxon was able to raise its dividend last year, keeping it on the list of dividend aristocrats. The stock's dividend yield is now 5.2%. We think that the energy sector should be included in any portfolio. Exxon supplies about 4% of the world's energy needs, producing the equivalent of more than 4 million barrels of oil and natural gas a day. And if we're incorporating anything from the energy sector, Exxon should be a strong candidate. Number 1. Union Pacific. Union Pacific delivers the goods families and businesses use every day with safe, reliable, and efficient service. Operating in 23 western states, the company connects its customers and communities to the global economy. The board of directors of Union Pacific Corporation has declared a quarterly dividend of $1.18 per share on the company's common stock, payable March 31, 2022, to shareholders of record February 28, 2022. Union Pacific has paid dividends on its common stock for 123 consecutive years, so you don't want to miss out on that. So those are the 7 stocks that will pay you up to $1,800 per month. These stocks are pretty safe, and if ever we approach a market crash, you can simply buy more of these stocks because they're potentially going to pool a lot of cash. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!